video. Okay, and we're back. So we're going to flip over to slide 25, and we're going to start talking about the technical requirements for the application of section 84.1. And what you're going to see is that unlike most anti-avoidance rules in the Act, which have nebulous purpose tests built in, where there's language like one of the reasons, one of the main reasons, the principal reason, etc. There is none of that in section 84.1. It is a series of bright line tests. So if any of the conditions on slide 25 do not apply, then section 84.1 does not apply. So that's relatively easy, which is potentially the saving grace of section 84.1. This may not be the case forever. There were some attempts to modify section 84.1 to drag some series and series type language into it as part of a tax amendment package in 2017. That got bounced, but I think a lot of people feel like that may make a comeback at some point, although probably not this year from what we're hearing. So anyway, conditions of application. As you can see on the slide, excuse me. As you can see, first of all, we have to have a taxpayer resident in Canada who is not a corporation. So that tells you that section 84.1 only applies to transactions that are initiated by individuals or trusts, right? Because those are your taxpayers who are not corporations. So our individual trust has to dispose of shares of a corporation to another corporation. Okay, that's relatively straightforward. The shares disposed of have to be capital property, which, okay, certainly if we're talking about private corporation shares, given the Supreme Court decision in Irrigation Industries, and given the Federal Court of Appeals' recent affirmation of that in Gervais, shares of a private corporation almost certainly going to be capital property, so we can probably just assume that one away. Next, the shares that are disposed of are shares of a corporation resident in Canada, which again, in this course, we can basically assume that away, that our original issuer corporation is always going to be resident in Canada. And again, that's a pretty easy bright line test to check off whether it's met or not met. You kind of know where the corporation is probably resident. So that's easy enough. Taxpayer and the purchaser corporation do not deal at arm's length. This is the more complicated part. This is the remotely complicated part of section 84.1. So as you'll recall from when we talked about arm's length related, affiliated, associated groups, etc., people who are related are deemed not to deal at arm's length under paragraph 251(1)(a). Individuals who are beneficiaries of a trust are generally deemed not to deal at arm's length with the trust under paragraph 251(1)(b). And otherwise, however, whether two or more individuals or any two or more persons generally deal at arm's length with one another is a question of fact under paragraph 251(1)(c). So there's actually been some recent case law just clarifying the arm's length test, and it's a recent Federal Court of Appeal case called Keybrand Foods from late 2020. And what that case basically says is, look, it's really a two-part test for arm's length dealings. One is whether a corporation, whether one person controls the bargaining for both sides of the transaction. So is there a common mind who's controlling the negotiations of that led to the transaction on both sides? And or do the parties have separate economic interests. If the parties don't have separate economic interests, or if there is a controlling mind who dictates both ends of the transaction, then you probably have a non-arm's length transaction. And the way that one of the useful measures of whether you have an arm's length transaction or not is to ask yourself if this is the sort of transaction that ordinary people having their own commercial interests would enter into a similar transaction at a similar price, right? That generally indicates that you do or do not have an arm's length transaction. Again, though, it's a question of fact, so that your two-part test and your guidance about looking for ordinary commercial transactions or similar commercial transactions, none of that is definitive or determinative. It's possible that you could have a non-arm's length transaction on some other basis if the court just decides that factually it's not an arm's length transaction. So that's the main judgment point part of section 84.1. And then there's the last requirement is that after the disposition of shares by our individual or trust, the purchaser corporation and the subject corporation, which is the original issuer corporation, that those are connected to one another. So you'll recall from when we talked about Part 4 tax that whether persons are connected is determined under subsection 186.4. Based on the case law and some clarifying amendments to the Act, the reference to subsection 186.4 in section 84.1 necessarily incorporates the reference to subsection 186.2. So people can be connected if one corporation controls the other, either based on direct shareholdings or based on all shares owned by non-arm's length persons with the dividend recipient, or the corporations can be connected if the dividend recipient corporation owns 10%, owns more than 10% of the votes in value of the shares of the dividend payer corporation. So in this case, the question is basically if a hypothetical dividend were paid on the shares of the subject corporation acquired by the purchaser corporation, would they be connected at that point in time? Yes or no? If yes, then that condition is satisfied. So those are the technical requirements for section 84.1 to apply. Everybody okay with that? Okay, seeing nobody, we can flip to slide 26. And here we can start to see part 1 of what happens if section 84.1 applies. So if we have a transaction where share consideration is received, where all of the conditions of section 84.1 apply and share consideration is received, whether or not the share consideration is the only consideration, then paragraph 84.11a provides for a grind to the puck of the shares. This makes sense that this is the tax consequence, because there's no immediate tax payable, because if you took back high puck shares on a transaction to which section 84.1 applies, you would still need a subsequent transaction to to actually use the puck of the shares. And so causing a grind to the puck of the shares it effectively causes that subsequent transaction to have tax consequences. So it gets you to effectively the right spot. Like I said, you have to deal with paragraph 84.11a in any section 84.1 transaction where there's share consideration, because it feeds into the tax consequences where you have non-share consideration as well. And if you have only share consideration, then paragraph 84.11a just determines the entire world of tax consequences. But so if you have no share consideration, then paragraph 84.11a is irrelevant and you can ignore it. But even if there's a single solitary share, you have to think about paragraph 84.11a. So what we can see if we flip to our acts, we'll see that paragraph 84.11a works on a formulaic basis, and our formula is, we have in brackets a minus b, and then outside of the brackets multiplied by the fraction c over a. And so when we're looking at these amounts, okay, paragraph a is the total variable a is the total added to the puck of the shares of the corporation as a result of the transaction. Variable b is the greater of the puck or the ACB of the transferred shares. Variable c is the addition to the puck of a particular class of shares as a result of the transaction. And then the bottom of the fraction, that variable a, is the same one. So what we will do, I think, as you would expect, is you figure out variable a, figure out variable b, subtract the variable b from variable a so that you can reduce the brackets, and then multiply that amount by the fraction c over a. So pretty obvious order of operations, right? So what will happen is that the bracket amount is the total amount of our grind. That whatever that bracket pushes out as a net number is how much the puck of the shares has to be reduced. And then the c over a fraction determines how much you reduce the shares of the puck of the shares of a particular class. So if you have only a single class of shares that has had a puck addition as a result of a section 84.1 transaction, then c over a just computes to 1 over 1, and then you know that the entire puck addition the entire puck grind gets allocated to that one particular class of shares. So I think by and large in this course we're always going to have this with only one class of shares. So c over a in this course is pretty much always going to be a 1 over 1 fraction, but in real life you could have situations where it is not 1 over 1. You're going to have to allocate the grind. So that may be a little bit complicated. So we can deal with that with a question. And so if we go to problem 4a and slide 27, we can see how paragraph 84.11a is supposed to work. And again, we're dealing back with question 2, but we're now pretending that that section, well, not pretending, we're now acknowledging the existence of section 84.1 in answering question number 2 and determining what happens. So and this is our base iteration of question 2. So our shareholder A is going to incorporate BCO, transfer the shares of ACO to BCO in exchange for Class B shares of BCO that would, but for section 84.1, have PUC and ACB of $500 in total. And and then they're going to get there because there's going to be a capital gain realized theoretically, but for section 84.1 as a result of that transaction. And again, permissible under the ABCA. Then we have our intercorporate dividend followed by a repurchase of the Class B shares of BCO. So what happens? First of all, it's important to work through our conditions of application to make sure that section 84.1 applies on these facts. So the answers it probably should be, we're going to make the assumption here that everybody involved, ACO, BCO, is resident in Canada And like I said, pretty safe assumption here that the shares of ACO are capital property. So we're good there. A is an individual, so we're good there. Has disposed of the shares of ACO to BCO. A does not deal at arm's length with BCO because A controls BCO, and therefore we know that under subparagraph 251(2)(b)(1) and paragraph 251(1)(a), they're going to be deemed to not deal at arm's length because they'll be related by virtue of control. And ACO and BCO are going to be related, or sorry, going to be connected after the transaction is completed under paragraph 186(4)(a), because either we've transferred all of the shares and BCO controls ACO, or because BCO and individual A, who's related to BCO and therefore not at arm's length, combine to control ACO. So we can assume that all of our conditions of application for section 84.1 are satisfied on these facts. So in this case, where we know that our only consideration on the disposition of the Class A shares of ACO by individual A to BCO, our only consideration is share consideration. So all of our tax consequences should be determined under paragraph 84.11a. And so what we're going to start with here is that our maximum puck grind, the theoretical upper limit of the puck grind would be the $500 that was added to the puck of the Class B shares of BCO on the transaction. So the puck of 500, that maximum theoretical puck grind or maximum puck addition, that's our variable A amount when we go to our formula in paragraph 84.11a. So then we can go to variable B in paragraph 84.11a. And we know that our puck and ACB of the Class A shares immediately prior to the transaction was $100. Both the puck was $100 and the ACB was $100. So the greater of the two amounts, it doesn't matter, they're the same amount. So our variable B amount is going to be $100. So then in our brackets, when we put in real numbers, it's 500 less 100. So we know we have a puck grind of $400. So then we can take our fraction C over A in order to apply the puck grind. So in this case, the variable C is the amount added to the puck of our Class B shares of BCO, which is $500. And variable A is the same as variable A before, which is $500. So C over A is 500 over 500, which just reduces to 1 over 1. And so our puck grind is $400 and is entirely attributable to the Class B shares of BCO. So the result of the puck grind then is that the puck of the Class B shares has dropped from $500 to $100. So the shares that are now owned by individual A immediately after this transaction now have ACB of $500 and puck of $100. So nothing has happened that would cause A's capital gain to go away, but now we have no puck in the shares. So nothing changes on the intercorporate dividend from ACO to BCO. That's still a tax-free intercorporate dividend under subsection 112(1). The corporations are connected, presumably no Part 4 tax. Then what's going to happen is on the repurchase of the Class B shares of BCO, we don't have a dividend under section 84.1. So paragraph K of the definition of proceeds of disposition isn't going to reduce A's proceeds of disposition from the original disposition of the Class A shares. So A still has that capital gain of $400. But on the repurchase of the shares now, our individual A is going to realize a deemed dividend of $400 under subsection 84.3, which is the amount by which the repurchase price of $500 exceeds the puck of the shares of $100. So we have a $400 deemed dividend. And because our proceeds of disposition in that transaction are reduced under paragraph J of the definition of proceeds of disposition in section 54, then our individual A has proceeds of disposition of the Class B shares of BCO of $100, ACB of $500, and realizes the $400 capital loss. So that could be carried, that could be applied against the original $400 capital gain. So the net result is going to be that our individual A has the $400 deemed dividend under subsection 84.3 on the repurchase of the shares as a result of the paragraph 84.11a puck grind to the original disposition. So that is our situation. So if that was, if that was your client, especially if they thought they were going to claim the capital gains deduction, the net result is $400 deemed dividend tax at 42.30% and probably a very irate individual A when the CRA comes to get them. So that's that. Everybody okay there? Yeah, Jacob.
Could you please just review paragraph K again?
Yeah, okay, so paragraph K of the definition of proceeds of disposition in section 54, which we're going to talk a little bit more about in a second when we go through paragraph 84.11b. But basically what paragraph K of the definition of proceeds of disposition does is it reduces the amount of proceeds of disposition otherwise determined by the amount of any dividend that was deemed to be received under section 84.1. So if you have a situation where there is a section 84.1 deemed dividend, which we're going to see in a moment how that could happen, then proceeds of disposition otherwise determined get reduced accordingly.
Thanks.
Yeah, no problem. Anybody else? Okay, so again, going back to our acts, we can now flip to paragraph 84.11b. And so going back to the high level for a second, when non-share consideration is received, okay, paragraph 84.11b effectively provides for a deemed dividend to the selling shareholder. This is because the shareholder has received money from the purchaser corporation or has received something that's tantamount to money, like a shareholder loan account credit, without the opportunity for any further tax consequences to arise, since the transfer of money or the repayment of a debt generally doesn't have any tax consequences. So if you have that happen, then paragraph 84.11b is going to deem there to be a dividend immediately, and paragraph 84.11b deemed dividends, these are what get people sued. People can be annoyed about their puck going away if they haven't used it yet or attempted to use it yet, but immediate deemed dividends when people weren't expecting them tend to not go well. So if we want to figure out what's going to happen with paragraph 84.11b, the first step is always to figure out the paragraph 84.11a amount, right? It could be that if there's no share consideration, the paragraph 84.11a amount is 0, which is a perfectly acceptable number, but you have to know that. You will always have to figure it out. So if there is share consideration, you've got to grind through the puck grind. If there is no share consideration, you just have to tell yourself that and know that it's 0, but that's step one. So then if we look at flip back to our acts with that piece of basic background, we can see that we have two brackets. One is A plus D, and then the other is E plus F. So what we have is a deemed dividend equal to the amount by which our A plus D bracket exceeds our E plus F bracket. So A and D, again, paragraph A, or sorry, variable A is the same variable A as in paragraph 84.11a. So variable A is just the total increase of the PUC of all of the shares of the corporation, but for the application of section 84.1. So in our example that we'll see how this goes in our when we do a problem, but just imagine whatever that number, what you want it to be. Okay, and then variable D, this is a new one. Variable D is the fair market value immediately after the disposition of any non-share consideration received. So basically, in most of our examples that we would use in this course, it's the fair market value of the shareholder loan or the amount of money that's received by the individual who disposed of the shares. Variable E, so that's our A plus D bracket. Then we can shift to our E plus F bracket. Variable E is the greater of the paid up capital or the ACV of the transferred shares. So that's pretty straightforward. And then variable F is the amount of the PUC grind that was determined under paragraph 84.11a. So again, that's why I say that we need to always compute paragraph 84.11a first. Even if it's 0, we need to know that, because variable F is just the PUC grind amount. So that's how that works. Hopefully everyone's kind of following that. And so what will happen is, after you've gone through that, like I said, whatever the amount that formula spits out, that is your deemed dividend amount. So, and I think now this comes back again to a question that Jacob asked last week, which is about this deemed dividend. And so this deemed dividend under section 84.1, if you have one, it will recover RDTOH because it's a dividend. And in addition, it can be designated as a capital dividend. So if you had CDA, you could designate it and it would be less of a concern. You could also designate it as an eligible dividend if you had GRIP as well. So it's just like any other dividend in that sense. So we can then sort of illustrate how this works again. And we can go back to, we can now go back to problem 2 again. And this is slide 29, and it's problem 4, and it's directing you back to problem 2, and it's now directing us back to the part of problem 2 where our purchaser corporation, our purchaser corporation issued a note as the only consideration for the shares of ACO that were issued to the purchaser corporation. So we don't need to go over the conditions of section 84.1 again, I think, because we just did with this problem, twice. So we probably don't need to do that a third time. I think we know that section 84.1 can apply on these facts. So now we just got to figure out the so what part of section 84.1 applying. And so first of all, like I said, we always need to compute our paragraph 84.11a amount. In this hypothetical that we have, where the only consideration taken back is a promissory note, then we know that our paragraph 84.11a amount is 0. There's no PUC grind. So that's easy enough. Then we can turn our attention to our formula and to our A plus D bracket. And so in our A plus D bracket, we have variable A, which is the amount of the PUC increase of all the shares of the corporation as a result of the transaction, but for section 84.1, well, that's 0, right? There was no share consideration, no PUC additions, so variable A is 0. Then we can go to variable D, and Variable D is the fair market value of our non-share consideration. So the fair market value of the promissory note. I think in this course, we can always assume that a debt has a fair market value equal to its principal amount. Obviously, like we talked about before, we talked about corporations purchasing debt on the open market, etc. We know that's not true, that debts can have a very different fair market value than their principal amount. But let's, in this, for these purposes, it's complicated enough. Let's always assume that a debt has fair market value equal to its principal amount. So variable D is $500. Which is the amount of the note that got taken back. Then we can go to variable. So we at that point we can just reduce our A plus D bracket. And so we know that A is 0, D is 500. So A plus D bracket is $500. So good to go there. And then we can go to our E plus F bracket. And variable E, we know that that is the greater of the PUC or the ACB of the transferred shares. Here we know that the PUC and ACB of the transferred shares was $100, so neither is greater. $100 is just the answer. So variable E is $100. Then we can go to variable F, and variable F is the amount of our PUC grind. And again, we know that there was no non-share consideration. Sorry, there was no share consideration taken back. It's all non-share consideration. And so as a result, we know that variable F is 0 because we know that paragraph 84.11a produced a nil result. So that is our E plus F bracket. It's 100 plus 0 equals 100. So we have 500 minus 100 equals 400, and that is our deemed dividend amount. So individual B receives a $400, or individual A receives a $400 deemed dividend immediately upon the shares of ACO to BCO in exchange for the promissory note. The remainder of the transaction works exactly the same as before. Again, everybody is a taxable Canadian corporation, still connected. Intercorporate dividend is still tax-free, presumably no dividend refund, so no Part 4 tax. No tax payable at all as a result of the 112(1) deduction in the absence of Part 4 tax in BCO. And then BCO, there's no tax consequences when the note gets repaid for either individual A or for BCO. This is where paragraph K of the definition of proceeds of disposition comes into play, though, is that to avoid our individual A getting double taxed, the amount of this deemed dividend of $100, or sorry, $400 rather, that feeds into paragraph K of the definition of proceeds of disposition in section 54, and it reduces the proceeds of disposition by the amount of the deemed dividend. So the proceeds of disposition go from the 500 otherwise determined to 100 as a result of deducting that $400 deemed dividend. So our individual A has proceeds of disposition of $100 in this transaction and had ACB of $100. So individual A realizes no gain or loss. They would have had a gain otherwise determined, but they don't realize one as a result of paragraph K of the definition of proceeds of disposition. They just have a $100 proceeds of disposition, and so a nil gain or loss, and the $400 deemed dividend is their main tax consequence. So everybody okay there? Okay, I'm seeing nobody. We can then flip to slide 30, and this is problem 5 in handout number 18. And what it's asking us to do now is we're gonna tie this whole thing together. So let us now suppose that we had a mixed transaction. So same basic fact pattern as problem 2. But now, instead of taking back either $500 of shares or $500 of debt, what our individual A is doing instead is individual A is going to take back $300 of shares. So the shares are going to have PUC and ACB of $300, the Class B shares of BCO, and a $200 promissory note. So we can now, knowing this, again, we would go through our conditions of application. We've now gone through this, basically the same iteration of this problem like 4 times. We know the conditions of application are satisfied, so we can be a little bit lazy here and just skip the conditions of application. We know section 84.1 can apply on these facts. So again, we start by computing our paragraph 84.1 1A amount, if we know it applies. So we know that our formula is A minus B multiplied by C over A. And so our variable A is the total PUC addition to all of the shares of the corporation. And so we don't have, we know that our variable A amount is $300. Variable B gets a little bit more complicated here, because now that we have non-share consideration, we can take a closer look at what variable B says in detail. And variable B talks about how the amount of variable B is the greater of the PUC and ACB over the fair market value of any non-share consideration. So in this case, where we had non-share consideration of $200 and PUC and ACB of only $100, variable B is actually 0 in this case, because the non-share consideration in fact exceeds the greater of the PUC and the ACB of the transferred shares. So variable B is 0. So our PUC reduction, therefore, should be the full $300 that was added to the PUC of the Class B shares of BCO. Our C over A formula, again, there's only one class of shares involved in this transaction. So C over A is just 1 over 1. And so the full $300 PUC reduction gets allocated to the Class B shares of BCO. So the PUC drops from $300 to 0. Then, variable B. Can we go over variable B again? Yes. So variable B, before we move on, variable B is the amount, if any, by which the greater of the PUC or the ACB of the transferred shares exceeds the fair market value of the non-share consideration that was received on the transaction. So if you have no non-share consideration, then variable B is just equal to the greater of the PUC or the ACB. If you have non-share consideration, then variable B is the greater of the PUC or ACB of the shares minus the fair market value of the non-share consideration, and only up to only to 0. There's no negative in variable B. So but in this case, where we have less PUC and ACB than we have non-share consideration, variable B, there is no amount, if any, by which the greater of PUC or ACB exceeds the fair market value of the non-share consideration. It's just 0. So variable B is 0 in this case. And again, so because variable A was $300, B is 0, and no problem. And C over A is 1 over 1. Then we again know that there's a $300 PUC reduction on the Class B shares of BCO. So then, with that knowledge, we can then flip to paragraph 84.1 1B. And now we're into our A plus D minus E plus F formula to determine the amount of our deemed dividend. So again, we start with variable A, which is the increase of the PUC of the shares of the corporation, which is $300. And we have variable D, which is the fair market value of the non-share consideration, which means the note, which is $200. So A plus D is 300 plus 200 equals 500. So that's the amount of that bracket. And then we can move to our E plus F bracket. So E is the greater of the PUC or ACB of the shares. And in this case, there is no, exceeds, et cetera. It's just the greater of the PUC or the ACB of the shares. So we know the greater of the PUC or the ACB of the shares is $100 because that's the amount of both. So it's neither is greater. It's just $100, and that's fantastic. Then we have our variable F. And variable F is the amount of the PUC reduction determined under paragraph 84.11a, and we know that's $300. So E plus F is 100 plus 300 equals 400. And so we then have 500 minus 400, and we have a deemed dividend of $100. So that's our total result in this case for under section 84.1 is we have a $300 PUC reduction and a $100 deemed dividend. So what you're going to see is that because of that amount, if any, by which language in variable B, what that effectively does is it gives priority in using your paid up capital or ACB, whichever is greater, to reduce the deemed dividend before it reduces the PUC grind. So your immediate tax consequences get dealt with first using that ACB or PUC. And then if there's more ACB or PUC, then it applies to reduce your PUC grind. So then we can also go back and we can flip to our shareholder A and their other tax consequences not determined under section 84.1. And this is where we had, because we know that this transaction, the tax consequences otherwise determined, right, would have been a capital gain of $400. But we know that now, because we have a $100 deemed dividend, paragraph K of the definition of proceeds of disposition in section 54 is going to apply, and it's going to reduce our proceeds of disposition by $100. So the proceeds of disposition have gone from 500 to 400. The ACB has remained the same at 100. So now I have only a $300 capital gain for our shareholder A. So at the end of the day, after we've applied section 84.1 and we've applied paragraph K of the definition of proceeds of disposition, our individual has a $300 capital gain, a $100 deemed dividend. They have a note with ACB of $200 that can be extracted at any time. And they have 300 Class B shares of BCO that have PUC of 0 and ACB of $300. So what would happen then is if we complete the cycle with the transaction, again, we know that the deemed dividend from ACO to BCO, nothing changes there. Still both taxable Canadian corporations, still connected. Dividend is going to be $500, not subject to Part 4 tax, presumably because they're connected and there should be no dividend refund. Section 112.1 applies, so no tax on the dividend. The note gets repaid with 200 of the 500 cash. Again, no tax consequences on the repayment of the note. And then we have the repurchase of the shares for $300. And that repurchase of the shares is going to result in a deemed dividend of $300 under subsection 84.3. And then when that repurchase happens, again, paragraph J of the definition of proceeds of disposition is going to apply to reduce our shareholder A's proceeds of disposition from the $300 otherwise determined to 0. And since our shareholder A had 300 of ACB in the shares and is now receiving proceeds of disposition of 0, there should be a $300 capital loss, which, sorry, my people have just been blowing up my phone and email all week. It's been brutal. Anyway, the proceeds of disposition otherwise determined were 300. They get reduced to 0, which results in a capital loss for individual A. And so as a result, there's a capital loss can be carried back to be applied, or not even carried back, but just generally applied against the capital gain from the original transaction. And so the result is going to be that our individual, after we've run through the entire transaction, we've applied section 84.1, we've applied all the other provisions of the act, should be at the end of the day net nil capital gain. And then we would have net $400 of deemed dividend that the individual is going to have. So they'll have paid tax at dividend rates after you've cycled through all of the relevant provisions of the act, if they're going to take out the full $500. It may be that they just take out the $200 and then stop, in which case we don't have to worry about section 84.3 and the second deemed dividend and the capital loss, etc. But in this fact pattern where the shares do get repurchased, then we do have to follow that all the way through. So is everybody okay there? Yeah. Sorry, I just had two quick kind of stupid questions, but whatever. So first, whenever there's a deemed dividend, we reduce the proceeds by that deemed dividend in the future? Not in the future necessarily, but just on the transaction. So in our transaction where the individual had proceeds of disposition of $500 on the disposition of the Class A shares of ACO to BCO, if there is a deemed dividend under section 84.1 as a result of that disposition, then that's where paragraph K of the definition of proceeds of disposition applies to reduce the proceeds of disposition by the amount of the deemed dividend. Okay. And then my second quick question, if there is if 84.1 applies, is the entire purpose just to make sure that it gets included as a deemed dividend instead of as a capital gain or loss? And that's why the ultimate result seems to be like nil for capital gains and losses? Yeah, that's exactly right. So the goal is that we're not going to double tax people, right? We're not going to cause them to have both a capital gain and a deemed dividend at the end of the day. Once the money comes out, they're not going to have both. That's right. So the goal is to make sure that they're going to be taxed once, but at dividend rates. Okay, thank you. No problem. Michael.
So under variables B and E, is there a reason why they also have the ACB in there and not just PUC?
Yeah, that was a deliberate choice. I think the rationale there was just where people were, just where shares have been in circulation for a long time. And where we've had this divergence between ACB and PUC. I think the rationale there was just that would allow people to use their ACB, which is what they really paid in order to extract money from the corporation, from their other corporation. And this also makes sense where you might be, you wouldn't do this with publicly traded shares, so it doesn't really matter, but where it really makes sense and where you'll really see this in practice is where people have died and they have ACB in their shares as a result of the deemed disposition on death, but not necessarily PUC. And so by having ACB here, you allow them to use that ACB to extract from the corporation and to avoid double tax in that way. So I think that's why. What you will see is in section 212.1 is that ACB isn't there. So for non-residents, you only get PUC. So it was a deliberate relaxation of the rules for Canadian resident individuals.
Okay, makes sense. Thank you.
No problem. Just gonna okay. So anybody else? All right, seeing none, we can flip to slide 31. And again, another slide that works really well when you're doing this live and does not work quite as well when you're circulating slide text ahead of time. But there's Admiral Akbar. This actually feeds in nicely to the question that Michael just asked. And we're talking about puck or ACB here, and this idea of the greater of puck and ACB, and that is a trap. This concept of the greater, and the reason for this is that ACB, for the purposes of section 84.1 and paragraph 84.11, subsection 84.11, is not necessarily ACB otherwise determined. It is in fact ACB determined in accordance with paragraph 84.1 to A.1. What this paragraph says in a really fancy way is that if a share is acquired from a non-arm's length person, including a chain of non-arm's length persons or a non-arm's length person who died before you were born, the ACB of this share does not include any ACB that is attributable to V-Day increment or to the capital gains deduction that was claimed by any non-arm's length person in that chain of non-arm's length persons. If paragraph 84.1 to A.1 applies, the ACB can be considerably lower than would be the case if you just used your ACB otherwise determined. So the portion of the ACB to which paragraph 84.1 to A.1 applies is known as soft ACB, and the ACB to which paragraph 84.1 to A.1 does not apply is known as hard ACB. So hard ACB is good for these purposes, soft ACB, bad. So if you hear those terms bandied around, remember soft is bad, hard is good, basically. So what are these things? V-Day value is really rare these days. I'm struggling to think of the last time I had a file where V-Day increment was actually relevant, and I cannot offhand. But basically what happened was, as those of you who are really big nerds about tax stuff will know, is that in 1971, we enacted the new Income Tax Act, have effect on January 1, 1972. And for the first time ever, we started taxing capital gains in 1972. And so in order to not hose people, we had this concept of V-Day and V-Day increment, where everybody got ACB in all of their property that they owned on what was called V-Day, which ended up being like December 20th, 1971 or something like that. And your ACB in your property that you owned on V-Day was the fair market value on V-Day. And so in order, like that's the idea, you just got free ACB in the property, because ACB was not a relevant concept in Canadian tax law before that time. So in order for V-Day increment to be relevant, you have to have a chain of ownership by non-arm's length people of the share, or a share substituted for the share, that stretches all the way back to like December 1971. So that happens, but it's not super common, right? Usually, especially in Alberta, the businesses were created post 1971, so you just don't have to worry about V-Day increment. But do know that it's there, and if you're dealing with an old corporation, whether it's, its successors through amalgamation, something like that, it's been owned by non-arm's length people for a really long time. It's a concern, and you will need to ask some questions about where any ACB in the system came from in order to determine where your hard and soft ACB is. Capital gains deduction is much more common. We're not really going to talk about the capital gains deduction in this course, but basically the way the capital gains deduction works is that if you have certain types of good assets, one of which is a qualified small business corporation share, the first $892,000, give or take, of capital gain realized on a disposition of that property is exempt from tax. And similarly, if you have certain farm or fishing property, that's called a qualified farm or fishing property, which in Alberta just means qualified farm property, the first $1 million of gain realized on a disposition of that property is entitled to a capital gains deduction, which basically zeroes out the capital gain that would otherwise have been realized from the transaction. And so that is a big deal in Alberta, and those of you who end up practicing here, especially in the private company space, it's going to be a big part of your life, the capital gains deduction. You will get to know those provisions fairly intimately. And so this is the bigger deal with soft ACB, is that if you have a chain of non-arm's length ownership of shares, and you have any capital gains deduction somewhere in that chain of share ownership by non-arm's length persons, then you know that you're going to have some soft ACB, and that's going to not count for the purposes of that greater of PUC or ACB amount. So, why we do this, I think this is pretty obvious, right? That we don't want, we're like we said when we were answering Michael's question, we're letting people have their hard ACB that they can pipeline out without having Section 84.1 apply. We're letting them do that because that's an amount they actually paid and paid tax on in order to generate the ACB. If they claimed the capital gains deduction or using V-Day increment, they never paid any tax. So we're not going to be as generous, and we're going to limit them to soft ACB or PUC in determining what they can extract. So that's Section 84.1 to 8.1. Does anybody have any questions about that? Okay, seeing none, we can flip to slide 32, which is the last thing we have to talk about today, which is why we're running a little bit long without taking a break. Slide 32 and paragraph 84.1 to B. And again, Admiral Akbar makes an appearance because this too is a trap built into Section 84.1. And so this is a pretty significant trap, because in commercial transactions, arm's length status is usually what people are relying on in order to avoid the application of Section 84.1. And I think, with the exception of GAR cases, where people have avoided Section 84.1 in a way that frustrates the purpose of the CRA tries to assess using the GAR, I think arm's length status has been the issue in every Section 84.1 case, other than GAR cases. So it's the critical issue, generally speaking, in a commercial transaction. So in addition to all the other ways we talked about that an individual could not be at arm's length with the corporation, paragraph 84.12b adds another. And what it does is it provides that an individual will not be at arm's length with the purchaser corporation if a group of 6 or fewer persons, including the transferor, controls the purchaser corporation after the disposition, and the same group of persons controlled the subject corporation immediately prior to the disposition. So that's seemingly on its face pretty straightforward. If the shareholders of the subject corporation are the same as the shareholders of the purchaser corporation, and it's a small group, so 6 or fewer shareholders, then you have you're in a bad place as a result of paragraph 84.12b applying. So to then make things a little bit more complicated, subsection 84.12.2 contains a number of supporting rules that tie into paragraph 84.12b. So for these purposes, shares of a corporation that are owned by the taxpayer's minor child or spouse, a trust of which the taxpayer, the spouse, or minor child is a beneficiary, or a corporation controlled by the taxpayer's spouse, or the taxpayer's minor child are attributed to the taxpayer. So basically, what that says in a fancy way is that you cannot avoid paragraph 84.12b by having your spouse, your minor child, a trust, or a corporation own your shares of one of the two corporations for you. Further, like in the context of the associated corporation rules, a group is defined as meaning any two or more persons, regardless of whether there is a sufficient common connection between them. And a corporation is controlled by both the smallest group possible and by every possible group at the same time. So just like in paragraph 256.1.2b. So essentially, if a transaction has even any potential of not being at arm's length, paragraph 84.12b and subsection 84.12.2 might cause the transaction to be deemed to not occur at arm's length. So if there is any overlap between the economic ownership of the subject corporation and the economic ownership of the purchaser corporation, you need to satisfy yourself that paragraph 84.12b and subsection 84.12.2 are not going to apply to pull you into subsection 84.11 on the basis that you're going to have a deemed non-arm's length relationship. So that's that. And I think what we can, if you want to see how that rule applies in real life, there's a tax court decision from a number of years ago. It was from the mid-aughts called Emery. And this is basically what happened in Emery, was that the taxpayer was a minority shareholder of the subject corporation, and he sold his shares of the subject corporation to a corporation that otherwise would have been at arm's length with him, in which he was also a minority shareholder, and he got boomeranged by paragraph 84.12b into section 84.1, and tried to go to court and argue that this was not in accordance with the purpose of the provisions. And as often happens in tax litigation, the tax court basically said, well, that's nice. Whether or not that's correct, you still lose because we don't have the jurisdiction to decide cases on that basis. So a pretty good case to go see how that works in real life. So does anybody have any questions about paragraph 84.12b? Okay, seeing none, we are done for the day. So I'm going to stop recording. Please